You've probably seen the headlines: inflation cooling, rate cuts coming, the market's celebrating every word the Fed says. But here's the truth most people miss. What the Federal Reserve decides in 2025 could quietly shape the next decade of your investments. Welcome to Invest Education Hub, where we turn market noise into smart investing lessons. Today, we're breaking down what the Fed's real plan means for stocks, bonds, and your portfolio this year. Stay with us until the end, because understanding this moment could change the way you invest for years to come.
This video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making investment decisions.
All right, so to really get a grip on where we're headed, we have to take a quick look in the rearview mirror. For the last few years, the Federal Reserve has been locked in this epic battle with something we all felt: historic inflation. I mean, look at this chart. The Consumer Price Index, that's the CPI, it rocketed up to a jaw-dropping 9.1% back in 2022. That wasn't just a number on a screen. That was the pain you felt at the gas pump and the grocery store. Now, since then, things have cooled off a lot. We've settled into this 2.5% to 3% range, and that's a huge sigh of relief for sure. But here's the kicker. It's not the Fed's magic number of 2%. And that small gap, well, that's where our entire story begins. So how exactly did the Fed put out that raging fire? Well, they pulled out the biggest tool in their toolbox: interest rates. In this timeline, honestly, it shows just how wild the ride has been. Think about it. In early 2022, the Fed funds rate was basically at zero. Borrowing money was incredibly cheap, which kind of fueled the fire. To cool things down, they had to slam on the economic brakes, hiking rates at one of the most aggressive paces we've seen in modern history, all the way up past 5%. And that brings us to today, 2025, where we're in this phase of just holding steady. And that for now is doing a lot of heavy lifting, because the biggest question on every single investor's mind is, what's next? Okay, let's dive in. Here's the game plan for today, our roadmap from confusion to clarity. First, we're going to look at what I call the Fed's tightrope walk. Then we'll pull back the curtain on their real strategy for 2025. After that, we'll connect the dots between interest rates, your stocks, and your bonds, and we'll debunk a big myth I call the rate cut illusion. And then we get to the good stuff, how you can actually position your portfolio and adopt the winning mindset you'll need to navigate all this. So first up, Section 1, the Fed's tightrope walk. Seriously, picture this. Someone is walking on a high wire, hundreds of feet in the air. That's the Fed. On one side, if they move too slowly, they fall into the fire of inflation. On the other side, if they move too aggressively, they fall into a deep economic recession. Their job is to slow things down just enough to get to the other side safely without crashing the whole economy. It is an incredibly delicate, high-stakes balancing act. And this is where the real drama is. You see it in the headlines every single day. You have the stock market, which absolutely loves cheap money, acting like a kid in a candy store, getting hyped up for rate cuts. Investors see one good inflation report and they immediately start chanting, okay, time to cut, let's go. But then you have the Fed, acting like the responsible parent, stepping in and saying, whoa, not so fast. This massive gap between what the market wants and what the Fed says it's going to do is the reason we're seeing so much back and forth, so much volatility right now. This analogy really just nails it. Think about it. You're driving down a really steep hill. You're gently tapping the brakes to control your speed. If you take your foot off the brake too soon, what happens? The car doesn't just keep going, it starts accelerating again, maybe even faster than before. For the Fed, inflation is that car, and that steep hill is our economy. Their absolute biggest nightmare is declaring victory too early, cutting those rates, and then watching inflation come roaring back to life. A second wave would be devastating. It would be harder to fight, and it would completely shatter their credibility. And that is exactly why they are being so careful. And that caution brings us right to the heart of the matter, to Section 2, because we're seeing a really fundamental shift in the Fed's entire strategy. You see, they're no longer in full-blown 5-alarm fire emergency mode. The mission has changed. It's not about fighting anymore. It's about managing. It's about making sure those last few embers don't suddenly flare up into another wildfire. So this leads us to the billion-dollar question for us as investors. If they're not just trying to smash inflation into the ground at all costs anymore, what is the Federal Reserve's real goal in 2025? What are they truly trying to achieve? Because if we can understand this one thing, it unlocks everything else. And here's the answer, laid out plain and simple. The old goal, the emergency goal, was an active war, fighting inflation. The new goal is way more nuanced. It's managing inflation. This means they've shifted from being firefighters to being more like forest rangers. They're willing to keep interest rates higher for longer, not to punish the economy, but to make absolutely certain that inflation stays down for good. Let's be really clear about this. The Fed does not want to cause an economic crash. That's the last thing they want. Their number one priority right now is maintaining control. They want stability, they want predictability. They would much rather have slightly slower, boring economic growth with stable, low inflation than a red-hot economy that risks another painful inflation surge. This desire for control, that's the key. That's driving every single one of their decisions.
So what does this control mode mean for your money? Well, it directly changes what kind of investments tend to do well. When money isn't practically free anymore, the market's preferences shift. Those speculative, high-growth stocks that are built on promises of future profits, they become a lot less attractive. Instead, investors start looking for quality. They want established companies with real earnings, steady cash flow, and maybe even a nice dividend. And, as we're about to see, boring old bonds suddenly become exciting again, for the first time in what feels like forever. This leads us perfectly into Section 3. We're going to connect that high-level Fed strategy directly to the assets sitting inside your portfolio. Because here's the thing. Every dollar you've invested, whether you realize it or not, has some kind of relationship with interest rates. So let's break down exactly how the Fed's decisions are sending ripples through stocks, bonds, and even the cash in your savings account.
We're going to tackle this one by one, looking at the 3 core categories that every investor needs to understand: stocks, bonds, and cash.
Okay, first up, stocks. In a world with higher interest rates, it's just more expensive to borrow money. It's that simple. And that's a direct headwind for a lot of those flashy, growth-heavy tech companies. You know, the ones whose super high valuations are based on earnings that are way, way out in the future. Many of them rely on cheap debt to fuel their growth. On the flip side, who's favored in this environment? It's the companies that don't need to borrow as much. We're talking about high-quality companies with strong balance sheets, very little debt, and most importantly, real, consistent profits today. Investors are basically shifting from focusing on hype to focusing on health. Solid fundamentals are back in style. All right, now let's pivot to bonds. And to really get this, we need a quick teaching moment on a super important concept called duration. Now, don't let the name scare you. In simple terms, duration just measures how sensitive a bond's price is to changes in interest rates. Think of it like a seesaw. The longer the bond's duration, the more its price will go up or down when interest rates move. So if you believe rates are headed down, a longer duration bond is your friend because its price will pop up more. But if you think rates are going to stay high or even rise, shorter duration bonds are the safer bet. Understanding this one concept is absolutely crucial for investing in bonds right now.
So why are we spending all this time on bonds? Because for the first time in over a decade, they're actually offering you a decent return. Look at this number, 4 to 5%. That's the kind of yield you can get right now from a broad, diversified bond index fund, something like Fidelity's US Bond Index Fund, FXNAX. After years of getting next to nothing, being able to lock in a 4 or 5% return with way less volatility than the stock market, that makes bonds a really attractive, really relevant part of a balanced portfolio again. They're back in the game.
And finally, let's touch on cash. Right now, high-yield savings accounts and money market funds are also paying out these great rates, 4 or 5% even. And it's really tempting to just say, you know what, I'll park my money there and wait this out. And look, holding some cash is a smart move. It gives you stability and the flexibility to jump on opportunities. But you have to remember this quote, cash buys time, but not growth. Even if you're earning 4%, if inflation is at 3%, your real return, what you're actually gaining in purchasing power, is only 1%. Cash is a fantastic short-term tool, a safe harbor in a storm, but it is not a long-term plan for building real wealth. Okay, let's keep it moving to Section 4, where we're going to tackle one of the biggest psychological traps for investors right now. I call it the rate cut illusion. Every time there's even a whisper that the Fed might cut rates, the market just goes wild, right? It rallies in celebration. But we really need to dig in and understand why that very first cut isn't always the green light that everyone assumes it is. History gives us some major clues here. I mean, the pattern is incredibly consistent. Let's just look at the last few times the Fed started a new rate-cutting cycle, back in 2001, in 2008, and even for that brief moment in 2020. What happened right after that first cut? It wasn't some immediate blast-off rally. In fact, more often than not, it was followed by an initial dip in the market and a lot more volatility. But why? Well, you have to ask why the Fed is cutting rates in the first place. And usually, the reason is because the economy is showing signs of weakness.
That first cut is often a signal of trouble ahead, not an all-clear signal. This all comes down to understanding how the market thinks. Markets are always trying to look ahead. They try to anticipate what the Fed is going to do months in advance. But they also have this tendency to overreact, both on the way up and on the way down. The hype around that first potential rate cut can create a short-term frenzy. But smart, disciplined, long-term investors, they understand this historical pattern. They get their portfolios ready for potential choppiness before all the excitement hits, not during it. They prepare, they don't react. Which brings us to the most important part of our whole discussion, Section 5, how do you actually position your portfolio for 2025? We've talked about the Fed strategy, we've talked about market psychology. Now, how do we translate all that knowledge into a steady, practical strategy for our own investments? This is all about taking back control. Here it is, the 5 core principles for a resilient playbook for 2025. Number 1, and this is always number 1, maintain your diversification. Please don't go all in on one thing. Number 2, focus on quality. We're talking about companies with strong financials, low debt, and real earnings. Number 3, revisit bonds and fixed income. As we've seen, they can provide a valuable anchor of stability and income in your portfolio now. 4, it's worth considering some global exposure. If the Fed does eventually start cutting rates, the US dollar might weaken, which could actually be a tailwind for international stocks. And number 5, the most important rule of all, stay patient and stay consistent. Your greatest superpower as an investor is time and the magic of compounding. And this chart right here gives you a great visual of what that balanced, diversified approach looks like in concept. You've got different slices of the pie, some in domestic stocks, some in international stocks, a slice for bonds, and a slice for cash. Now, the exact percentages will be different for everyone, but the principle is universal. By spreading your investments across different asset classes, you're building a financial shock absorber. So when one part of your portfolio is having a tough time, another part can help pick up the slack, smoothing out the ride for you over the long term. And that brings us to our final, most important takeaway. The Fed's plan isn't about making the stock market happy every single day. It's about trying to build long-term economic stability. And as investors, our job is really the same. This quote says it all. In every cycle, it's not the first mover that wins, it's the steady one. Trying to perfectly time the market, trying to guess the Fed's next move, it's a losing game. Building a solid, diversified plan that you can stick with through good times and bad, that is the proven path to long-term success. Starting your investing journey doesn't have to be complicated. It just needs to be consistent. Remember, time in the market always beats time in the market. If this video helps you understand how the Fed's plan connects to your investments, make sure to hit like, subscribe, and turn on the notification bell so you never miss new videos about investing, fidelity, ETFs, and financial freedom. And if you're ready to take the next step, check out our video on diversified investments for 2025. It'll show you how to build a balanced portfolio for any market. Thanks for watching, and I'll see you in the next one, here on Invest Education Hub, where we turn learning into lasting wealth.